Okay, now let's understand in this section what are the essentials of options. What do we really need to be able to trade options? So there are around five to six essentials. What are those? The first and foremost is a call, then the put, then premium, strike price, expiry date, and the naming convention. Let's go one by one and understand what these are. Now we already understood what is a call, what is a put. Call is the buyer of a call gets the right to buy, and buyer of the put gets the right to sell. It's the right but not the obligation. That much we understood. Now if the buyer of the call has the right to buy, what would this buyer of call want the underlying price to do? Does he want the price of the underlying to go up or come down? What does he want to do? That's the question. That's the very important question, right? That you have to kind of understand. Similarly, for a buyer of a put has the right to sell. If he has got the right to sell, what does he want the price of the underlying to do? Does he want the price of the underlying to go up or come down? What does he want to do? Think about that. Think about that for a second. What does he want to do? So let's kind of describe that. Always a buyer of a call. If somebody is a buyer of a call, he has bought the right to buy the asset. When somebody is buying the asset, why will they buy? They buy the asset. Like for example, if you have to buy an equity share, why will you buy? You would want the price to go up, yes or no? You would want the price to go up, right? So similarly, with that reason, buyer of a call would also want the price of the call, price of the underlying to go up. Here is the price of the underlying to go up. Very, very simple. Buyer of the call wants the price to go up. Price here is price of the underlying to go up. Similarly, buyer of the put, exactly opposite. Buyer of the put here has the right to sell. Right to sell the underlying, which means he's got the right to sell, which means he's the seller of the underlying. Seller of the underlying means is to short the market. So once you are shorting the market, so for example, Tata Motors is going down and you choose to short the market. What would you want the price of the Tata Motors to do? Would you want it to go up? Absolutely not. You would want the price to further go down. So a buyer of the put wants the price to go down further. So it's very, very important. These two is extremely important. You guys, you should exactly have it always in your mind. No ambiguity. Buyer of the call, underlying go up. Buyer of the put, underlying come down. As simple as that. Premium is what you pay for buying an option, call or put, and it has got intrinsic value and time value. Time value we will discuss a bit in the next section, little bit deeply what it is. Intrinsic value is the value what it is made up of. Since if the value of the asset goes up accordingly, what is intrinsically it, that's what it is in a crude way. We will not go deeper. We don't need to go deeper, at least at this level, whatever we are learning here. If you want to go deeper into all of these concepts, we have advanced options learning where we talk about all of these in a very, very detailed way. But now this much is good enough for you to start trading in options. Next is the strike price. Like I said, strike price is the price at which the contract has been agreed for buying or selling the underlying. As simple, the price at which the contract is exercised, and the expiry date is the date on which the contract will expire. All contracts have to expire. They cannot remain in forever. So here in NSE, all the options contract are valid for 3 months. 3 months. So after the end of the third month, it kind of expires. And name is the name of the script. And how is it named? It is named this way. The naming convention is it has got the name of the script first, followed by the date of expiry. Date is the date of the expiry. Then CE or PE accordingly. CE means call European. And the strike price, 16,300 here is the strike price. Similarly for PE, 15,800 is the strike price. There will be various strike prices. We will come to the strike price in a bit. So that is how the whole convention, naming convention is done. So now to summarize, the essentials are very, very important for you to be able to trade in options. So you got to know all of this, and you should remember this all the time. What does premium mean? What does strike price mean? When is the expiry? What does PE mean? What does CE mean? What does the buyer of PE want? What does the buyer of CE want? Now there is buyer and seller of PE, CE. What does the seller, we talked about buyer of PE, buyer of CE. Now, buyer of call, we know what does he want. We know buyer of put, what does he want. Now, what does the seller of call want? What does the seller of put want, right? Start thinking about that. It's opposite thinking, right? So you have to kind of understand all of this at any given point in time, right? Because options, since they have multiple variables, it is not as straightforward as trading in futures. Futures is similar to equity. Equity goes up, future goes up. Equity comes down, future comes down. Simple, over, right? But here in options, based on the instrument what you're trading in, if you're trading in call, if underlying is if you're trading in call, if underlying goes up, call price also, call premium also goes up. But for put, it's opposite, right? If you're trading in put, if underlying goes up, put actually kind of goes down. So you want the put to underlying goes down, put goes up. So it's opposite, right? So you have to kind of start thinking on those lines. So that's why specifically focus on essentials. And if you're kind of ready and getting this one, type in the comment, getting essentials. Awesome. I'll see you in the next video. We'll talk about the strike price. See you in the next video. Bye-bye.